All right, how are you? This is Daniel Clayman. This is going to be a video focused on multifamily development analysis. I'm gonna show you exactly how to analyze any size development deal, multifamily mixed use, 5 units, 500 units. I'm gonna show you how to determine what to pay for land and to quickly figure out whether the deal works or not before you get too far into bidding of the land or further into the process. So really quick, my name is Daniel Clayman. I live in Richmond, Virginia. I build real estate and I build software for real estate investors. All right, so very short intro. Why is this important? So first of all, this is not going to be the typical fluff motivational bullshit videos that you're used to seeing on YouTube. We're going to go deep into the nuts and bolts of how to do these types of deals. And really, nobody is teaching this, especially for free. Nobody's really teaching real estate development at all. We're probably one of the few people that put out content on real estate development and are letting you sort of peek behind the curtain. Because when I got started doing this stuff, I had to figure it out all on my own, and I've been trying to give back and show other newer investors how to get in the game and kind of shortcut your way to success. So, if real estate development seems complicated or if it seems out of reach, fear not. It doesn't have to be daunting. Multifamily mixed use development to a lot of people that are trying to get into it probably seems pretty daunting. And one of the things that we're going to try to do is make it make sense, because it's not as complicated as it seems. Now, there are a lot of moving pieces to the puzzle, but we're going to show you how to piece all those pieces of the puzzle together. So, the way to master anything especially that seems complicated, is to break it down into smaller, tangible, easier to digest components. Once you master the basic principles that I'm going to show you today, you can apply those to every single deal you see and massively cut down on the amount of time that you waste trying to analyze deals, trying to make sense of deals, right? And make no mistake, you must master deal analysis before you master anything else, including construction. Again, this may not seem sexy, right? This seems sexy, but before you do this, or before you master this, you've got to be able to master this. So, as a matter of fact, get your calculator out. We're going to do some math in this video. All right? You can do it here, or you can go and sign up for a college class at an overpriced university. Your choice. So, you make your money in real estate. There's a couple of almost cliche by now sayings, but they're insanely true. You make your money in real estate when you buy, not when you sell. It's when you buy. It's all about making sure that you buy correctly. In case of development, you want to make sure that you're not overpaying for land. Preferably, you're buying land at a good enough price that gives you some room to the downside and allows you to make some mistakes, because you will make mistakes. I make mistakes. I've made mistakes. We all make mistakes. And the better you buy, the more room for mistakes you'll have. So the other saying is, how do you eat an entire elephant? Well, one bite at a time, right? So that's what we're going to do today. So the same principles you use to figure out what to pay for a house. If you are watching this and you are a house flipper, or even if you're a wholesaler, or if your experience is primarily with single family houses, the same principles you use to figure out what to pay for a house to rehab applies to what you pay for land for a 200 plus unit ground up deal, right? You start at the end. What can I build? When you're looking at a piece of land, you need to ask yourself, what can I build? What am I going to build on it? That's going to determine the value that you place on the land. Forget what the seller is asking. Forget comps, right? A lot of inexperienced people, when they're looking at land, they want to find comps. Value of land is much more subjective than the value of a single family home, right? The value of the land depends on what can you build, and then what are you going to build. So in this case, we're going to assume we're building apartment buildings. Once you figure out what you can build and what you're going to build, then you're going to ask, what will this apartment building be worth when it's built and stabilized? And I'm going to show you in this video exactly, I'm going to walk you through a case study of this. Then you're going to back out the desired sweat equity that you want to achieve when the construction is done. You're going to back out the cost of construction, soft costs, hard costs, plus closing costs. And then you're going to arrive at max value that you can pay for the land. All right, so here's the process in more detail. First of all, when you're looking at a piece of land, what we typically do is do a density study to see what can be built on it. Then we determine the as-built value of the building that can be built on the land. Then back out, step 3, back out desired sweat equity. Step 4, back out ballpark construction costs and soft costs. Step 5, that gets me to my max land price. Step 6, I then want to evaluate my short-term financing based on my constraints and loan options, because that can, in this environment, I'm recording this in at a time when interest rates are going up fast. So in this environment, the financing can make or break the deal, and it's breaking a lot of deals, right? Step 7, I want to evaluate my takeout or permanent financing options, because without that, there is no deal. Step 8, I want to make sure that the deal meets all of my investment criteria: debt coverage, cash and cash, other investment criteria. And then if none of this gives me a deal that I like, I'm going to go back and adjust my offer in the land, or I'm going to adjust the plans for the property accordingly to make my numbers work, or I'm just going to walk away from the deal. All right, so we're going to go through this in much more detail. All right, let's look at an example. Let's say you found a piece of land that let's say it came off market from a seller, right? You found this piece of land. All right, how do you place value on it? It's an infill lot. So first of all, for the purpose of this training, and primarily what I do in my business is I do infill development. That means that there are already utilities at the street. There's typically good topography with the site. I don't have to build roads, pave roads, build streets, sidewalks, right? Infill development, I'm building on existing lots. So the first thing I'm going to do is I'm going to look up my zoning, and I'm going to see that this lot is zoned for up to 10 units. Now, I have another video on my YouTube channel where I cover how to rezone something and the various options you have for rezoning, and I'll link to it here. But in this case, let's assume it's already zoned for 10 units, and I'm not going to try to rezone it to get more density out of it. As I look at my zoning, I can see that per the zoning code, I can go up to 3 stories by right. So now that I have that information, what do I pay for the land? What do I build? And will it work? So step 1, do a density study to see what can be built. So this basically means make sure that you can actually build 10 units here that are not going to suck. Just because the zoning allows you to build 10 units, because of the various other constraints of the zoning code or the site, you may not be able to put 10 units there that are going to make sense. Maybe the site has half of the site is flat and the other half completely drops off into via a hill, for example. Well, if you can only go by right 3 stories, you're going to have a hard time actually putting 10 units there. Just as an example, right? So chances are, if it's a flat site, and chances are, if there are no soil issues, if there are no other problems or easements with the site, that's something else you have to check for, is easements. But if it's a fairly flat site, unencumbered with easements, chances are, if zoning allows 10 units, you can put 10 units there and build a good product. But if you're not sure, you can do a basic study yourself, or what I typically do, because I have regular architects that I work with, I will have my architect do a density study for me. So this is an example of a much more complicated site. That's 5 acres where my architect did a density study for me, and he laid out, because the site is very challenging topographically, he laid out a potential combination of buildings on the site to see what we can actually fit there, and it turned out to be less than what the zoning allows. But here's a simpler density study. This is a 10,000 square foot lot. Zoning, in this particular zoning code, requires And I want you to follow me here because nobody, it's so few people in this game truly understand zoning, except for very experienced developers. If you can master this, you're going to be further than almost anybody else in your market, especially people trying to get into development, right? Let's assume zoning requires 1,000 square feet of land per dwelling unit. That means a 10,000 square foot lot will allow 10 units here. Maximum lot coverage is 60%. That means the building itself, the footprint of the building, cannot take up more than 60% of the lot. The rest has to be devoted to parking, green space, trash enclosures, etc. The building can be up to 35 feet in height, which tells me I can do 3 stories here. Between 10.5 and 11 feet per story. 9-foot ceilings plus another 16 or 18 to 24 inches for trusses. I can do 3 stories here. It requires a side yard setback minimums of 5 feet. And then the front yard setback means the building has to be at least 5 feet away from the property line in the front. And it requires 1 parking space per unit. So I can literally do this basic zoning study myself on the back of a napkin, or I can send it to an architect. So here's an example. 60% max lot coverage means my floor plate can be 6,000 square feet. If I do 3-story building and each floor is 6,000 square feet, I can put an 18,000 square foot building here. That is way more than enough for 10 apartments, plus entries, plus common areas if I want. That's way too much. So I know I can fit a 10-story building here. And likely I still have enough room for parking, trash, green space, bike racks, etc. Right? So, in this case, my constraint is not lot coverage or setbacks. Step 2, make sure you have enough room for all of that stuff that I mentioned, parking, trash, other amenities. And in reality, what I'm going to do here is I'm going to reduce the footprint of my building because I don't need to build an 18,000 square foot building. My apartments are going to be way too big. So I'm going to reduce the floor plate and allow myself more room for parking, for trash, for green space. So this came back from my architect. This is what I can fit on the site, right? This is what my first floor would look like. And I still have room for 10 parking spaces, a drive aisle in the rear. We did a couple of versions of this, right? I sent this to my architect. He did a couple of versions. One is with a 2-way drive aisle in the back. This one is with a 1-way drive aisle in the back and 45-degree parking. But I can clearly see that I can fit 10 units on the site and still have enough room for parking, for trash, for bike storage, and even some green space. So, density study verified that I can build a 10-unit building here. Next, we need to determine your unit mix and rough unit sizes. Because again, 18,000 square feet for a 10-unit building is going to be way too much. My apartments are going to be way too big. They're going to cost me way too much to build versus the rents that I will get. So I'm going to determine the unit mix, rough unit sizes. Then we're going to determine as-built value of this apartment building. So now we're in step 2, determine as-built value. Step 1, I'm going to create a Pro-Forma. I'm going to run rent comps in the area. I can get rents from Zillow, from Craigslist, from HotPads, from Rent-A-Meter, or you can get them from your own portfolio if you already own some units in this market. We typically pull rent comps from our own portfolio because we typically have a really good quality product and our rents are often higher than comps. So 10 apartments. You're going to come up with a unit mix here that makes sense, right? In your market, you're going to determine that 1-bedrooms are in higher demand than 2-bedrooms. And from a income perspective, 1-bedroom apartments are usually more efficient in terms of rent per square foot than you're going to get versus a 2-bedroom. So you're going to say you're going to build 7 1-bedrooms and 3 2-bedrooms. And these are the rental rates that you're going to put into your pro forma based on the comps that you've determined. And because your lender is going to require you anyway, you're going to add a 5% vacancy rate here. So here's our pro forma. Here's our projected rent roll. $15,190 a month minus 5% vacancy, $14,430 gross operating income. So step 2, we've got our income. Now we need our expenses. So you can itemize these, and I'll show you in a few minutes exactly how to do that very easily. But in the initial analysis, I typically just ballpark my operating expenses as a percentage of my gross income. So the percentage of your operating expenses really depends on the kind of building that you're managing. Smaller properties with few common areas, no amenities, where all the utilities are sub-metered, should trend towards around 30 to 32% expense ratio from my experience. Now, if you're running them inefficiently, you're still going to be close to 40, but I've hit as low as 27% on my duplexes, which means that 27% is primarily property management, insurance, real estate taxes, maybe some landscaping. On larger properties that have amenity spaces that you need to maintain, common areas where you have to pay for utilities, on-site management, the expense ratio is going to be in the 40 to 50% range. If you're running at 50%, you're really running your building inefficiently. I've seen even larger buildings hit 35 to 37% before. It really just depends on the quality of the management and the type of market that you're in and the type of building that you have. It really varies, but that should be a rough ballpark for you. Smaller properties like this one. This is a 10-unit building, very few common areas. All the utilities are individually metered. You should be somewhere between 30-35%. So we're going to use a 35% operating expense ratio, which means our monthly operating expenses are going to be $5,050. So when we subtract that from our gross operating income, that results in a net monthly operating income, or NOI, of $9,379. So if you have your calculator out, you should be doing this math with me. My annual NOI is $112,554. Now, NOI is important because in commercial properties, that determines the value along with the cap rate. So step 4, I'm going to apply what's called the market cap rate to determine my stabilized value. Stabilized value means when this building is built and leased out and is operating at full capacity, what is it worth? So cap rate is simply annual net operating income divided by the value, or divided by the purchase price if you're buying. So value of this net operating income. So if you take this net operating income that we projected and apply a 10% cap rate to it, the building is going to be worth $1,125,540. If you apply a 5% cap rate, the value of the building doubles. So cap rates matter, and you should be paying attention to what cap rates are doing in your market in terms of how buildings are being appraised and existing buildings that are selling. Are cap rates going up? Are cap rates going down? What are the market cap rates right now? Right? So clearly, if you're buying, you want to buy at a high cap rate, and you want to sell, or you want to get your building appraised at as low of a cap rate as possible. So you need to find out what the market cap rate for these type of assets is in your market. That can come from market data, that can come from brokers. You can talk to your local bankers and say, hey, where are these types of buildings being valued and appraised at right now? Talk to commercial appraisers. CoStar has a lot of this data. It's expensive data. Membership in CoStar, they're a data company, is pretty expensive. So you should find a good local commercial broker that has access to the data and figure out what the market cap rate is, because it plays a crucial role in what this building will be worth. Because when you go to get your construction loan, your lender will take your plans, take your specs, take your finishes, take your floor plans, give it to an appraiser, and that appraiser is going to create what's called an as-built appraisal that will determine how much money for construction your bank will give you. And the cap rate that your appraiser uses is going to make or break this deal. So right now, even though rates are going up, cap rates have stayed largely compressed. We're going to use a 5% cap rate to value this building, which means that stabilized value, the as-built stabilized value, is going to be $2,251,080 when this building is built and leased out. So we just completed step 2. Now we're going to crank through steps 3, steps 4, and 5 at the same time. We're going to back out our desired sweat equity. We're going to ballpark our construction costs. And then that's going to get us to the max price that you can pay for the land. Ready? All right. So normally when you develop real estate, what you don't want to happen, obviously, and forgive me for if I'm stating obvious, but you don't want your total cost to equal what the property is worth when you've built it, because then you've spent a lot of time and effort planning and building and developing and leasing something when you could have just bought it for market value. So you want sweat equity. You want to create wealth in your balance sheet. Think of it as a profit margin if you were selling. So personally, I typically target at least a 20% sweat equity position when I finish the project. That means I want my total cost between buying land, paying all the closing, financing costs, paying construction costs. I want all of that to equal no more than 80% of what the property is worth when it's built and stabilized. That's how wealth in real estate development is created. So in this example, we're going to use a 20% sweat equity position. So we're going to back out that 20% from the as-built stabilized value of the property. That gets me to $1.8 million. And then I'm going to subtract out my construction costs, my hard costs, and my soft costs. So I'm using here a total of $170 a foot, but every market is different. Construction costs are changing rapidly. Ever since COVID, construction costs have been changing and rising rapidly. So don't just take the number that I'm using in this case study at face value. Research what things cost in your market. Talk to other local developers that are building similar projects. Talk to general contractors that are building these types of projects and find out what things cost. I think $10 a foot for soft costs. That means architectural fees, MEP engineering fees, civil, structural, real estate taxes, insurance while you're building the project. $10 a foot is going to get you right in the ballpark. As far as hard costs, right, the physical costs of construction, right now in my market, I'm seeing anything between $150 and probably a little over $200 a foot to build. So I can build this type of building for about $160. So I'm using a total of $170 a foot here, multiplied by an 8,000 square foot building. That gives me my construction costs of $1.36 million. So I'm going to back out from the value of my building. I'm going to back out my sweat equity and my total all-in costs to build. And I'm ignoring closing costs here and financing costs to keep this simple. But what you really should do is also back out your closing costs when you're buying the land and financing costs, right? But if I back out my equity position and my construction costs from $2,251,080, that gets me to the maximum price I can pay for land of $440,000. And if this is the number that I typically calculate, I'm going to offer quite a bit less because I at most want to end up here, and really I want some room for error. So I put a side note here, right? What happens when I was walking you through the density study, I showed you that you can build an 18,000 square foot building here. But we don't build more than we need to because construction costs go up significantly. So if you were building, for example, even a 10,000 square foot building here, that would cost you $1.7 million. And that would leave you with only $100,000 that you can pay for the land. It makes a big difference. This is also why you need to pay attention to your floor plans. You need to know what rents in your market. You need to know what 1 bedrooms, what size they should be, what size your 2 bedrooms should be, 3 bedrooms. You need to optimize the design of your building to get rid of needless hallways and common areas and make your building efficient, because construction costs are expensive. So now we figured out the maximum that we can pay for land. Now I can go and I can make offers on land. If you've gotten this far, congratulations, you already know how to do more than 97% of investors out there and really a bunch of real estate developers. So now we're going to move on to step 6. Let's say I have this land under contract. Now I'm going to start the next phase of my due diligence, or I can even do this due diligence before I make the offer on the land, because I want to make sure that just because I can buy the land at the right price doesn't mean the deal actually works, right? If my short-term financing is too expensive, if my permanent financing is too expensive, the deal might not cash flow. The deal might not work. So we're going to continue with our due diligence analysis. In step 6, we're going to evaluate short-term financing based on our constraints and loan options. And then we're going to take a look at takeout or perm financing. So I have a longer video on YouTube, which you can easily find, and I'll see if I can link to it here, on how to evaluate short-term and permanent funding options for multifamily projects. So I won't go into a ton of detail here, but I will say this: short-term financing and permanent financing have to be evaluated together. If you've got great construction financing, that's great, but it's pointless if you have no exit lined up to convert your loan to a permanent loan, or if your permanent financing is too expensive and the deal won't cash flow. That's a recipe for disaster, especially in a rising rate environment. So let's continue our analysis, and I'll show you exactly how to evaluate your short-term and permanent financing. And often we deal with lenders that offer both. They will give us a construction loan, and then that loan rolls over into permanent financing, amortizing financing, when the deal is built and leased out. So everything I showed you so far can be done on the back of a napkin if need be. Everything I showed you in this video to date, you can literally do on the back of a napkin if need be. And I urge you to rewatch this video if you need to, and internalize these concepts. But here, now that we're starting to plug in our financing options, things are starting to get a bit more complicated. So I'm going to show you how to make your life easy. So Rehab Valuator is a software that I've created that's now being used by tens of thousands of investors around the US and actually around the world. And even though it's called Rehab Valuator, we now use this software, and many developers use this software for ground up construction projects. And I've already created this deal in my account. Now, if you're not familiar with the software, there is a free version you can currently access that lets you do most of the analysis that I'm about to show you. And the premium version, there's going to be some things I'm about to show you which the premium version can do as well. Specifically detailed budgets, cost templates, project management, fundraising presentations. But let me show you how, first of all, to recreate what I just showed you on the back of a napkin, how to do that in the software very quickly. So here I have 2 exit strategies. I have flip and I have rent and BRRRR, and I can toggle here between rehab and construction. In this case, it's a construction project. So I just started this new deal, and the first thing I do is what I taught you at the beginning of this presentation, which is start at the end. I'm going to go here and create my pro-forma for what the property will look like once it's built and leased. So here I've got my operating income, 7 one-bedroom units, roughly 670 square feet. This is the monthly rent, 3 two-bedroom units, and I can keep going and going, and I can actually have as many unit types as I want in here. I can keep adding unit types, and if you have multiple layouts which will rent at different price points, you can put in literally 100 different price points here for your building. So you can use this for a 10-unit building, you can use this for a 500-unit building, and you can see the total Leasable square footage is 8,000 square feet. And I'm also assuming that this is going to be a very efficient building, mostly with outside or private entrances. So I'm not accounting for hallways here or common areas. 10 units total, and I'm adding a 5% vacancy. So right at the number that I showed you in the slides, gross operating income monthly is $14,430. And then I already went ahead and entered our operating expenses. Again, this very easily lets you build out your pro forma. You can enter your costs dollar per unit per year, monthly, annual. I went ahead and entered our projected operating expenses here, and they very closely match what we just went over on the slides. So I'm going to hit update, and then you can see my monthly net operating income, $9,380. So the next thing that I'm going to do is I can either manually at a 5% cap rate calculate the as-built value, or I can simply play around with this number until my cap rate based on ARV, or in this case ABV, becomes 5%. So pay attention to what happens to this number as I change this to 2 million, 5.63%. So we know that to get to roughly 5% cap rate, we need a value of $2,250,000. So this is my value. So we're working our way backwards. We figured out the income. Now we figured out the value based on the 5% cap rate. Now I need to back out my construction costs. So I'm going to go here under construction budget, and I'm going to click on this button. Now in the free version of the software, you can simply enter a lump sum budget. And if you remember, we had a budget here of $1,360,000. So you can simply do that. In the premium version, you have a full project management functionality. So I can go in here and I can build out a detailed budget with my soft costs. So I can start typing, for example, planning and engineering. This is my budget group. I can put in here architectural, and based on square feet, I'm going to say $3 a foot. I can add MEP, and I can start building out my budget in detail. Same thing with hard costs, site, but budget line item can be site clearing. I can go on, and I can add utilities, etc., etc. Or I can simply go here to templates, and there are some public cost templates that we make available to you here that come pre-populated with all the budget line items that you can use to build out your budget and scope of work. And I have some private templates that I've saved based on my project. So I'm going to go here, click on multifamily template based on the past project that's similar. And you can see all of my line items here come pre-populated. My budget is $1,316,000. I just have to go in here and adjust some quantities. In particular, I have all kinds of takeoff shortcuts here that I need to go and fill out, and my budget will be adjusted once I start filling in these takeoffs. And we have detailed project management tutorials and all of this. So let's go back and let's just enter a quick lump sum, $1,360,000. And now I just need to calculate my offer for the land. So I'm going to click on this little max offer calculator button. I've got my ABV. I've got my construction costs. I'm going to zero this out for the sake of simplicity. And I'm going to enter my target percent of cost here is 80%. This gives me my sweat equity. And I'm going to click calculate. And there you go. Here's my max offer for the land, $440,000. I'm going to click use this. And now I've got my offer price. So now I'm going to go in here and I'm going to assume that I'm actually paying $375,000 for this land because, again, I want to build myself room for error. So what I'm missing now in my analysis is financing. You can see I'm buying this land for $375,000. I'm going to spend $1,360,000 to build. My construction is going to take 12 months. And it's going to take me another 4 months to stabilize the property. So I can see here that actually, because I'm buying my land cheaper than 440, my total cost basis is only going to be 77% of value. And if I was doing this all with cash, you can see that my monthly cash flow would be $9,300 with a 6.5% cash and cash return. Now, in today's world, that's pretty good, right? So in this case, my cash and cash return mimics my yield to cost. And we'll talk about what yield to cost means in a second. But now what I need to do is factor in my financing, because I'm probably not going to do this deal with $1.7 million in cash. That's not sustainable. So here I've got inputs for my short-term financing. And then here I'm going to refi it into permanent financing once construction is done. So let's start with short-term financing, because this is where the rubber meets the road. You have to make sure that you can get adequate financing that doesn't leave you with a ton of cash needed for the deal that you can't come up with. And then you have to make sure that your permanent financing works. So most lenders right now will cap you at, what I'm seeing is really 65 to 70% of cost. You might be able to find 75% of cost, but let's just be optimistic and say 70% of cost is what your lender will give you, total cost of the project. One origination discount point. We'll assume another 50 basis points for other closing costs paid to the lender. We have to pay the points up front with an interest rate of, let's say 6.5%. Right now, again, as of this video being recorded, that's likely what you're about to see. And it's going to be a floating rate throughout construction, most likely. But let's assume that you're looking roughly at 6.5% short-term construction interest-only financing. So what did that just do to my cost basis? It went from 77% to 81%. That means my financing is going to cost me 4% of my deal value. I can click on project summary and I can actually see a summary of exactly what my financing costs will be. 12,000 in origination points, closing costs, and then interest on purchase and construction money. So about 90 grand is what my financing is going to cost me. Okay, this doesn't break the deal. But now after my construction is finished, I have to refi into permanent financing. And that's where I'm going to go to here and I'm going to click yes. And then let's assume I can refinance this deal at 75% of appraisal. So 75% of this number. At also 6.5% rate, amortized over 30 years. This is, you should be able to find permanent financing right now that looks about like this. 75% of appraisal, 6.5% interest rate, amortized over 30 years. Some local banks may insist on 25, but let's assume we can amortize this loan over 30 years. So my new mortgage payment, this is my new loan amount. But here's the problem. And this is where a software like this becomes really valuable. I can see that 75% refi will not work because my debt coverage ratio, and this is where constraints come in. This is where all of your constraints have to be taken into account. Look, you're looking for a debt coverage ratio of at least 1.25, right? That means that your net operating income should be at least 1.25 times what your mortgage payment is. Lenders will require this to make sure that you have plenty of income coming in to cover the debt payment. In this case, I don't have enough net operating income coming in to cover my debt payment. So I have to scale this number back from 75 to 70. Pay attention to what happens to this number. 65%, 60%, 55%. Even at 55% of appraisal, I'm still only 1.2. 50%, there we go. So if I refi at 50% of appraisal, I can hit a good debt coverage ratio. But that means I'll have to bring an additional $100,000 to the closing table just to refi. So what if we play around with this number and say 53%, 52%? There we go. 52% of the new appraisal gets me to a 1.27 debt coverage ratio. And I'm going to have to bring a little bit of money to the closing table post-construction in order to refi into this permanent debt. Now, maybe by the time I build it, rates go down to 6%. This is why you have to play around with the numbers. So what am I looking at here? When I refi, I'm going to have, well, this is kind of an evil number, huh? $666,000 of cash tied up in this deal. On balance sheet, I'm going to have a total of over close to $1.1 million in equity. My monthly cash flow is going to be $2,000, and I'm going to earn a 3.6% cash and cash return. Is this a deal worth doing? I think a lot of people would say no. The culprit right now in this environment is the interest rate. And this is, again, why you need to do this analysis, because just because you can buy the land at what seems like a good price, once you factor in financing into account, the deal may not look all that great. Now, what if I were to go into my operating income and say, you know what? I think I can push my rents a little bit higher. I think inflation will continue, and I can get $14.99 for my ones and $18.99 for my twos. Now the deal starts to look more attractive. I'm earning off the bat 5.1% cash and cash return on my money. On top of that, I'm getting amortization, depreciation, and appreciation. These days, if I can do a deal that has a cash and cash return of over 5%, I'm going to do it because I'm a long-term investor and building long-term wealth. But this is why you have to take everything into account before you close on the land. It's not just about buying your land correctly, but it's about making sure that your short-term financing and your long-term financing will work. You know, can I come up with $610,000 in cash to do this deal? Can I bring in a partner? Do I have the cash myself? Can I bring in a partner to do this? Can I bring in a gap lender? That's beyond the scope of this training, but that's all of this has to be taken into account. Now, what I'm going to do from here is go out and raise the money. So first of all, and let's go to my slides here for a second. So we're in step 8. Ensure deal meets minimum debt coverage ratio, cash and cash, and other investment criteria. So debt coverage ratio, we just went over it. The income from this deal, when stabilized, must be able to cover the debt payments. Your projected NOI caps how much you can borrow long term. You need to hit a bare minimum of 1.25 DCR. So if you have a $10,000 mortgage payment every month, you need a minimum of $12,500 in net operating income every single month. Cash and cash. When permanent debt is in place, how much your or your investor's cash is left tied up and what rate of return is it earning? This is probably my most important metric right now when I'm doing deals. If I have to leave cash tied up in this deal, will it generate a sufficient enough return year one? Yeah, you know, I put in these slides that I shoot for a minimum of 10%, but again, anything over 5% lately has been acceptable. Because again, on top of that 5%, they get appreciation, depreciation, and amortization. And that is how real long-term wealth is built. So, other important investment criteria: internal rate of return, yield on cost, debt yield. You know, if you're syndicating, you're going to have general partner IRRs, limited partner IRRs, payback period, etc., etc. So let's hop back in. Our debt coverage ratio is good. Payback period is long, right? For me to earn back my cash at this cash and cash return, it's going to take me close to 20 years, but I fully expect my net operating income to grow every month, every year. And eventually I'll be able to refi out and get my cash out. Cap rate of property based on cost basis, that's the same as yield to cost, right? What is my return on cost? And I'm working on a major, huge update to the software where I'm going to add a lot more deal analysis capabilities and a lot more return metrics here, especially for development projects. But what I'm going to do from here is I am actually going to go out and raise money. I'm going to approach my lenders, and here's how I'm going to do it. I'm going to click on reports, and in the premium version, all of these marketing reports that you can use to sell your deals as a wholesaler and a broker, to raise capital, and the project management reports, all of these are unlocked. And so what I'm going to do is I'm going to create a 4-page presentation that I typically, and our clients use this, and I have used this to raise tens and tens of millions of dollars from local, regional, and national lenders. I'm going to put together an executive summary, marketing sheet hold, Pro-Forma, and some additional pictures. So let me show you what this looks like. First of all, here I've got my executive summary that I can edit with my company logo. I'm going to rename this to Financial Projections, Short-Term and Long-Term Funding. And I can enter a headline here if I wish. And I'll show you this in detail in a second, but this is what we use to raise money. This is my 1-page Pro-Forma showing my income, expense projections. Every lender will want to see this. And by the way, I can export this to Excel if I wish, and then additional pictures. So what I will do is click Get Unique Link. This creates a unique web page for this presentation, and I can email this to my lender, to my banker. And what they will see is the executive summary. And actually they can, on the summary itself, they can zoom in, zoom out. They can get a satellite view of the area. How cool is that? My financial projections. So this is what I'm showing to my lender. This deal will be worth $2.25 million. I'm buying the land for this much. Here are my construction costs, my total cost basis. This is how much cash is going into the deal. This is the loan amount that I'm seeking. Here's my projected net operating income, projected timeline, and then here are my permanent debt projections. Permanent debt, equity left in the deal, monthly cash flow, and then debt coverage ratio given my permanent loan. This makes you look like a pro, answers all the questions that your lender may have before they even have a chance to ask you. Here's my 1-page Pro-Forma. And then what I typically do is because I want my lender to visualize this project, I want to show them my track record. I'm including here pictures from previous projects of finishes and of units that we'll include in this project. Now I can add all kinds of things here to my presentation. If I go back and I go back to my detailed budget, I can include in my presentation construction budget. So now I will send my lender, in addition to the 4 pages that I showed you just now, I will send them my full construction budget. Do you think this might make you look good? So I can use this to get short-term financing, I can use this to get long-term financing, or I can use this to get both. Oftentimes the same lender will give us both construction funding and long-term funding. I'm not going to go into a lot of detail here, but other things that we can do with the software. Full project management suite. I've got visual drag and drop scheduler here. In other words, Gantt chart, right? So I can create a full schedule for my project. I can create templates around these schedules so that if I repeat the same type of project, I can preload schedules and just change dates. There's a full accounting system in the software that's brain dead simple. I've got document storage for my bids and for all my transactions. There is a functionality here which allows me to track my project in real time as I enter my transactions. I can track budget versus actual. Incredibly user-friendly. and incredibly useful. And then I've got push button lender draw capabilities here as well. So as you are completing your project, instead of doing lender draw requests in Excel, which is a nightmare, you literally push a button, create draw, fill out percentage complete for each item, click a button, and it generates your draw request. And this is just a small glimpse of what the software does. I don't want to go into a long presentation here because we don't really have time. But if you're serious about this business, I highly recommend you sign up. I've showed you about 30% of what the software can do, and we're working right now on a major release. So I hope you've enjoyed this training. Leave me your comments, questions, feedback below. I try to answer every comment and every question, unless it's silly or crazy. Even then, I'll probably still reply to you. Share this on social media with your real estate friends. I would really appreciate it if you shared this video. I don't think a lot of people are doing training on development, especially for free. So if you found this training valuable, please share it, like it, comment. If you don't have Rehab Valuer Premium yet, you can go to rehabvaluer.com/upgrade and sign up. The software is very affordable, but it's invaluable in our development business. But we also have wholesalers that use it, house flippers, rehabbers. It works for almost any type of deal, right? Burr investors. And when you upgrade, you're going to get the full funding presentation capabilities, full project management suites. You're going to get all of our cost templates pre-built and pre-populated for you, along with a lot of deep training. And that's it. Go build something. Thanks for watching.